Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to today's episode of the Prime Property Finance Podcast. My name is Mark and in today's episode we are going to talk about buying a company. This is a property finance podcast. Why on earth are we talking about buying companies, you may ask? Well, specifically, we're talking about buying companies that own properties. So landlords that own properties, multiple properties in a company and buying the shares of that company as opposed to buying individual properties. So who's this episode for, you may ask? Well, it's for those investors that are actively looking to take advantage of perhaps a landlord that's tired, considering retiring. There's a lot of change going on in the industry at the moment, as I'm sure you're all aware of, and they're looking to exit. Now, they've got a problem, and that problem is that they've got multiple properties and you can't just sell them. You have to wait for the ASTs to mature. Then you have to do some work on the property, get it to a saleable standard. Then you have to advertise, sell it. It all takes time. Plus, you may want to time which tax years you do these things in for tax purposes. And it can take years and years for somebody to actually unwind a property portfolio. So whilst they're great vehicles, unpicking it can take a significant amount of planning and time and effort. Now, if you're looking to buy and you can buy all of them at once, through a mechanism, through a company, buying a company, then you are in a great position where you can fix that problem really, really quickly for them. Okay, so we're just going to explore that in a bit more detail going forward. So without further ado, let's get into this. Now, I've got an example that I just want to run through with you, and I try to keep it as simple as possible. I'm sure you can get better numbers than this, but I'm hoping this will just prove the point as to why buying the shares of a company may be better than buying the individual properties. Okay. Now, there are pros and cons to both, and we'll go into that in a little bit as well. So in this particular example, we've got a landlord who wants to exit the sector, wants to sell their portfolio. Now, all of them exist in a limited company. Okay. And there are 10 properties in this company, each of which are worth £100,000. So maths nice and easy, £1 million purchase. Okay. Each of those properties has a mortgage on them of £60,000. So total mortgage of £600,000. So loan to value, 60%. Nice little portfolio. Okay. You may have negotiated a discount and you're agreeing to buy this at £900,000 because obviously you're fixing a problem for them as well, meaning you've negotiated yourself a 10% discount. Again, as I say, you may do better than this, but these are just the numbers to prove a point. So purchase price is £900,000. Maximum loan to value, say £75,000. That means you can have a mortgage of £675,000 to buy it with a deposit of £225,000 coming from yourself. Now, that doesn't sound spectacular, and I'm sure you're going, well, what's so special about this? Well, it's not so much that there's something special about it, but when you realize that buying shares has a different rule in stamp duty than it does to buying property. And that is that stamp duty is charged at 0.5% on the purchase price of those shares. So you're buying them from £900,000, meaning your stamp duty liability is now £4,500, which, as you can appreciate, is significantly less than if you went and bought 10 properties valued at £100,000. Now, other ways in which you can do this, you may be able to actually leverage the higher value. So rather than leveraging the purchase price, you may be able to leverage the actual value of the property portfolio. If you did that, then you could potentially raise £750,000 in terms of borrowing. Your deposit would be £150,000 towards the purchase price, and then that in conjunction with a stamp duty saving means you're only putting in 16% as an actual deposit into this. Okay. Now, there are certain dynamics that have to be in play for this to work. It isn't quite as straightforward as I've just spelt it out. As I said, I'm just using this example to demonstrate to you how this is a viable option going forward. Okay, what you will notice though is that there are very few instances where you're going to get away with not putting any money into this. The deal would have to be exceptional, and you would have to have a very strong track record behind you in order to get away with not actually putting a significant amount of money of your own into it. What this means is that you're reducing the cost of buying it by way of the stamp duty, and you're also potentially reducing the amount of deposit that you would need to contribute to the transaction overall. Okay, you may want to use bridging finance. Is a good tool that potentially you can use to do this. That's probably the most relevant way of leveraging the actual value as opposed to the purchase price. And invariably in these situations, these properties are also needing some love and attention as well. So you need to factor that into the consideration also. Okay, so that's an example as to why you may do it. It's also worth noting buying the shares of a company is a very different legal due diligence process than it is to simply buying a property. Okay, there will be larger legal costs, the due diligence they need to go through in the back end, because you inherit the liabilities of the business as well as the benefits of it. And I don't just mean the liabilities in terms of mortgages. There could be other liabilities, i.e. it may not have paid its corporation tax properly, or there could be other liabilities sitting in the background. There might be a claim, a personal injury claim coming and down the road, all sorts of things. So that needs to be fully ironed out with your solicitors. I would suggest you do not cut corners on that front. The actual borrowing itself, so how you structure this, it would be a loan or a bridging loan, whichever the mechanism would be, a mortgage rather. And what happens is you set up a new company. So you would set up a new SPV, new limited company, and that is the vehicle that's going to buy the shares, not you personally. Okay, it will be the company. So what will happen is we will lend, or the lender will lend to what we call the topco. So that's the new SPV you've just created will be the topco. That will buy the shares, 100% of the shares of the new company. So you would create a small group structure where you'd have topco and target company. And we would loan to topco, and it would then subsequently lend the money back down to settle all the debt, etc., etc. Okay, so a very well-trodden path. This is extremely common in buying or trading businesses, this structure. That's effectively, we're borrowing that structure to do this. It's very, very specialist. So I would suggest that you get real advice when you're looking at this. We're obviously more than happy to have a chat with you and explain to you some of the intricacies and nuances that exist within this. But it is certainly something to explore if you were looking to buy a portfolio off of somebody. So that's something to consider. So definitely get the right advice. This is very specialist, so you won't have a queue of lenders wanting to do this. We have to go into a space to make sure that we can deliver on what we say we can. And we also want to work with lenders who've got experience in it as well. So we don't want those challenges midway through the process, especially if you've had to outlay valuations on 10 properties and so on and so forth. So just bear that in mind as well. Pricing wise on mortgages, yeah, pretty standard. You're not going to be hit with 15% mortgages or anything silly like that. It is very much a specialist space. Your rates are going to be more akin to that of commercial mortgage rates. So don't be expecting sort of your 4.5%, 5% per unit. This is quite a specialist type of lending, as I mentioned. Now, you may roll your eyes at the slightly higher costs, but obviously the saving, you want to make sure that the benefit of what you're doing is outweighed by the cost of actually doing it in the first instance. And as I say, it's a great way for you to get yourself into a portfolio while reducing this or making savings on the tax and so on and so forth. It may well be that after you've purchased this, you may choose to break these up and put them back onto more traditional mortgages. There's nothing stopping you from doing that at a later date. But it's just a vehicle to get you into it. So that money that you borrow, perhaps at a higher interest rate, doesn't have to be the money you borrow forever. You may want to put that in for a 2 to 5 year fixed rate. And then when your debt cycle comes up, then you can change lenders, break it up, put in 10 different mortgage lenders and so on and so forth as you see fit. Okay, so that's something to bear in mind as well. So really, really high level. There are obviously lots of complexities and nuances within this. So I just really wanted to spend 10 minutes just demonstrating to you that there are other ways to buy multiple properties over and above just buying property 1, property 2, property 3, etc. And this currently is quite an attractive way of doing things. Okay, so if that's of interest to you, drop us a line. More than happy to talk through in far more detail in that. It usually means more if you've got an example that you want to talk through. We can bring those figures to life and see what that actually means to you and your case in particular. But as I say, very high level overview, something to think about. If you do come across a portfolio that somebody's trying to exit, this is a very, very viable way of acquiring it. And who knows, you could see you adding 10, 20, 30 properties to your portfolio a lot faster than you think. So yeah, there we have it. So that's it for today's episode. I hope you enjoyed, hope you found value in that. And have a great weekend, and I'll catch you on the next episode. So thanks very much. Cheers for listening. Take care, guys.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.